Welcome, AP Stat students. So before the year closes out, I wanted to give you kind of a real life application of statistics. A couple of other ones would be insurance. Um, so this one is credit score, and I think it's a really good way to relate what we've learned this year to real life. A credit score is a way to measure risk for a lender. That could be you know, as a person, we actually put our money in the bank sometimes, and we're actually the lender in that case. And the bank pays us interest to keep our money in the bank. Now, the reason is when we put our money in the bank, the bank gets to invest that and take some risks against it. So we become the lender when we put money into a savings account. It's kind of fluid, so we get a low interest rate because there's only certain types of accounts where you have to keep your money in for a certain amount of time. Those are CDs and savings accounts where there's other agreements. So you get a little higher interest because you have to keep it in for a certain amount of time. The idea is that the bank gets to invest that money and try to grow it. So there's a little risk involved, but there's a larger reward. So credit score is when a lender loans someone a borrower money. And we kind of have to get a credit score from them to measure risk. Now, with a bank, if I put my money in the bank, it's pretty secure. There's pretty low risk. So there's also low reward. If it is a bank lending money to a borrower for a home mortgage or a car loan, there's a little greater risk to the bank. There's a much more likely chance of that person, something going wrong and that person not being able to pay back their loan, or some people just don't pay back their loans. Credit score is a way for a lender to measure that and get into kind of a risk reward analysis. So that's basically what it's all about. That's why it relates to our course in statistics. So let's talk quickly about credit and credit scores. You've heard some things about it, so let's go over some basics. Okay. So when you first start out at 18 years old, you can start to develop a credit score, or a credit score is being tracked for you. So when you first start out, your credit score is typically 300. Somebody that's had credit and used credit very well, somewhere near 850. Nobody really gets to 850, but you can get pretty close. Now, let's talk through the different, what I did was I found this diagram. It's a pretty good explanation of what's going on in the world. What you do is you start out with a very poor credit score, or let's say you do have experience, but something goes wrong. Go bankrupt, default on a loan, something like that, you're going to be in the very poor range. What that would tell a lender is that you're not very trustworthy. So buyer beware type of thing. Banks are not likely to work with you if you're in the very poor range. You're going to have to develop your score before any bank's going to consider loaning you money. Okay. Now, in this fair range, it's possible some credit card companies might work with you, but a bank's probably not going to give you a loan for anything that's significant. In this fair range, pretty much there's not a lot of choices. Now, as soon as you get in the good, very good, or exceptional, banks want your business, and so they will, they'll consider loaning you some money if you do apply. If you're in the good, you're not going to get as a consumer, you're not going to get as favorable of an interest rate. You're going to get some of the worst interest rates because these people are more of a risk than this exceptional person. So it's just how it'll work, and we'll see some examples of that along the way. So we'll get into how to develop our credit score, because that's going to be essential. But let's first start breaking down what are the different categories that make up our credit score. First is credit history. That's the most important. 35% of your score, give or take, has to do with your credit history. And that is going to be basically it's a spreadsheet or kind of an indicator of how you've paid back your loans. So let's say that you have a couple credit cards and maybe a car loan. What's happening is a credit calculation company, okay, Experian, there's other ones too. So this is one that we look at as Experian. There's Equifax, and there's another one. So there's there's three main credit score calculating companies that banks kind of go to, and they track in sort of a spreadsheet type of kind of calculation how you've paid back your loans. They take all your credit bearing accounts and see have you made on-time payments and paid them at least the minimum amount that's on that. So let's say you have a credit card and maybe put for that month you put like $800 on the credit card. What will happen is you'll get a bill for a minimum payment at the end of the month, and maybe that's $200 or something a little lower. If you've paid back at least the $200 by the due date, you will get a good hit on your credit score. So in your credit history, that'll be a plus in the on time and in full category. Now, if you don't pay the minimum or you pay it late, that's also going to be a different indicator in that spreadsheet. Every time you pay late, it's going to be a significantly negative hit on your credit. Okay. So what accounts contribute to the credit score? Any loan with a bank, car loan, house loan, student loan possibly. So those types of accounts are credit bearing. They're a loan. You're expected to pay back. And that all, those could contribute positively or negatively to your credit history. The other ones are credit cards. Those also count. What do not count towards credit score, and this is kind of a myth, is that putting a phone bill in your name will help your credit score. That's actually false. For a phone bill, what is happening is you're paying for a service in full each month. So there's really no borrowing. There's no loan there. Each month you get a bill for using their service, and you have to pay. You're expected to pay that in full. Now, I say phones technically are not credit-bearing accounts. Things have changed in the past few years where our cell phones are so expensive, they kind of build them in to the payment plans. And in that case, if it is considered a loan, that is a different story. So if you buy, say, your phone, you don't buy it outright, say you put it on your bill, technically that could be a credit account now because you owe for the phone. It just depends on how they report it. Now, what's different about, so say you do have a phone service and you decide not to pay it for a while, or a cable bill that you do not pay for a while, that could count negatively towards your credit history because let's say that cable company could report you for kind of defaulting on that account. So that would go negatively towards your credit history, but it's not supposed to count positively because, again, you're paying for the monthly service in full, expected to pay in full all the time and not borrow anything. All right, so credit history is huge. Even being a day or two late is a big negative, and it takes a long time to make up for late payments. So you'll have to have a lot of on-time payments to make up for one late payment. So keep an eye on that. Make sure that you're careful and you're paying back your credit bills on time. It's easy to let one go, and then all of a sudden your credit score goes right down. Credit utilization is the next most important aspect of your credit score, and it's probably one that's least understood. It's pretty obvious. Pay your stuff on time is credit history. Credit utilization is a little bit different. Not everybody understands this. Basically, what you have on a credit card account, say you have an American Express account or something, they might have a limit on the account of, just for the sake of easy numbers, $10,000. Okay. The limit is 10,000. Of course, you don't want to spend up to that. Really, what the recommendation is use it a little each month, up to but not exceeding 30% of that limit. Now, wait a minute. So you're allowed to put 10,000 on the card. Why not? Why is it a bad idea to go that high? Because what happens is, yes, they put a limit of 10,000 on it, but they don't expect you at all to get near that. Okay. If you're getting near $10,000, if you're getting near the limit, that means that you're using credit a little bit irresponsibly. You're in a tough spot where you're borrowing a lot of money. So credit score calculating companies don't like to see that. That's not a good thing. So if you have a $10,000 limit on your American Express card, the most you should put on it each month is $3,000. That would be 30% of the limit. So that's what credit utilization, the max recommendation is. Do not exceed 30%. Okay, so what if I only use $1,000 a month on my credit American Express card? Oh, that's even better. Okay, so you're under the 30% utilization rate. So it looks like you're using credit and you're using it responsibly. All right. Now, I would also, as a side note, I would recommend that whatever you put on the card each month, you pay it completely off each month. I would not recommend carrying a balance. There is an extremely high interest rate on most credit cards. So, let's say you leave $1,000 balance on your credit card each month. Well, that could amount to, $15 extra a month that you're going to pay just because you're not paying your loans off. So leaving a balance on your credit card account is really costly. So whatever you're going to use on your credit card, make sure you pay it off. You're able to pay the full amount off at the end of the month. Stay away from carrying a balance on those. Now, they will allow you to carry a balance. So let's say, again, you borrow $1,000 for the month on your American Express card. They'll give you a minimum payment to make, say like $200, $150. They'll say, yeah, go ahead and you can borrow some of this money. Well, whatever's left on the balance, they get a lot of interest for. Okay, so the rate's something like 18 to 20% every month. I'm sorry, not every month. Annual percentage rate. So each month it would add like 1.5 to 2% of the balance as interest. So it's really significant. You don't want to keep racking that up. Now, another thing that I've seen before with the credit utilization is a friend of mine, paid back his credit-bearing accounts all the time, on time, in full. Never got behind, never did anything wrong with his credit, and could not figure out why, after years and years of good credit history, why can't I get my credit score above 700? Okay. His assumption was, well, nobody really gets to the very good or the exceptional. Basically, you're stuck in the good. And that's not true. I said to him, well, most likely you're overly utilizing credit in some way, shape, or form. And, he of course argued and said, no, I'm nowhere near my limits. Well, okay, nowhere near your limits. What does that mean? Are you using under 30% on your credit card accounts? Okay, so we talked about that a little bit. And then the next part was, what really came to was he was a co-signer on other people's car loans, his kids, which I don't blame him. But that is going to be showing that there's a lot of credit utilized on your account. So you're gonna, if you're, let's say you do co-sign for a loan, that means you're vouching for whoever that other person is. That other person doesn't have a good enough credit score to get the loan on themselves, and they've asked you to become a co-signer. Well, this is what we want to avoid completely. This is why I teach students about credit. When we learn this in the next session is how to develop your own credit score at a young age, responsibly, carefully, so that when you go to, let's say you're 22 years old and you go to buy your first car on your own, You don't need your parents to co-sign. Now, of course, you're going to involve them in the conversation because it's a big thing to purchase a car, but you don't want to make them or ask of them, hey, I can't get this unless you co-sign. Well, that's a tough spot to put somebody in because it really does count against their credit. Let's say you pay a little bit late, or even if you don't pay late, it's still going to be showing that they're overutilizing the credit. So the whole goal here is to make sure that you develop your own credit steadily, safely, and understand what you're getting into. Okay. And not put another parent or another adult in a position where you're asking them to co-sign. Okay. So we'll come back to credit utilization with some examples eventually. Just want to explain that there is that category. New credit is something that people are aware of. There's commercials all over the place. Oh, don't check your credit score, and worried about checking your credit. Somebody looking into your credit, such as, let's say, a car company, if you give them permission to look into your credit, you give them your social security number or whatever, they can look at your credit score. And what that immediately does is it lets the credit score calculating companies know you are looking into something called new credit. It immediately lowers your score. Why? Because you're about to purchase something on credit with a loan. So they know that you're possibly getting into, a dangerous financial situation. So they're assuming that if you're borrowing money for something, that you're not in the most secure financial position, and your credit score is going to drop a little bit. That's even if you don't purchase the car. If the car company looks into your credit, obviously you gave them permission to. If they even look into it, it's still going to count on your credit. Okay. Something else that comes up. Let's say you go to a store and they, let's say we go into Kohl's and they say, do you have a store credit card? If you give them permission to look at your credit because you're thinking about opening a credit card, that again, that's considered new credit. Okay, it is going to lower your credit score temporarily. Now, this isn't necessarily a bad thing. Okay, looking into borrowing money is not necessarily a bad financial thing. However, as far as the credit calculating companies are concerned, it is something that alarms them and it lowers your credit score. Why I say timing is everything in this. So let's say that I'm in the search for a new home, a home mortgage, right? And I've got an okay credit score, but it's not really secure yet. So I'm younger, and I didn't really know how to develop my credit safely. If I'm in that position and I just barely made it where I qualify for a certain loan, if I go and say hit up Lowe's and purchase a bunch of items, they say, you could save 10% on your purchase by opening a store credit card. If you do that, not only are you looking into new credit for a home mortgage, which is a big ding on your credit, you're also looking, as far as the credit score calculating companies are concerned, you're looking for, now they're looking to borrow for other purchases, such as items at Lowe's. So that's a lot of new credit all at the same time. It really might lower your score significantly. And I've seen people where it lowered them just enough to knock them out of mortgage approval. So here it is. They buy all the stuff at Lowe's for their new house. They haven't closed yet. They're about to, but they know they need a whole bunch of new stuff. And they go ahead and get, a store credit card at Lowe's because they're about to buy a bunch of stuff. And all of a sudden it knocks them out of the category. So maybe their credit score was somewhere like, 680, in the good, but pretty low in the good. If something like that bumps you all the way down to the fair category, banks can't give you a home mortgage anymore. So that's, that has happened before. So timing is everything. You've got to know how your credit score can be affected by different credit moves and timing. Don't open a new store credit basically when you're in the same process of looking for a mortgage. So, all right, getting back to that, we'll come back to that another time. Credit mix, there's two types of credit that we can lump things into. Revolving, basically what that is the balance on the account. Actually, let's do it that way. The balance changes on all of them, but the minimum payment each month could change significantly. So this is on a credit card. So if let's say I have a credit card with American Express or Visa or MasterCard or whatever, each month I could charge a big difference. So personally for my family, we put a lot of purchases on a particular credit card, and it's not because we're borrowing money for the whole month. We're putting on there for the rewards, and we pay it off in full at the end of each month. So if I don't use the credit card, my minimum payment, let's say it's zero, right? I don't use that card at all that month. My minimum payment on that would be zero. Now the next month, I could charge up to $3,000 on it, okay, for groceries and all my other bills and everything like that. You'd be surprised how much it can rack up. So let's say I put $3,000 worth of stuff on that credit card. It's not recommended, by the way, unless you know where it's going and you're careful with it. But the minimum payment then the next month could be significantly higher. The minimum payment now might be $800 that month. So it went from 1 month of zero to the next month $800. So anytime your minimum monthly payment could change significantly, that's revolving. That's usually your credit cards. That's the best one there. Now, installment credit is something like a car loan. The minimum payment each month is pretty steady. Okay, so it might be $180 a month. Well, that's going to be the same every month until it's paid off. Okay, so installment, that's going to be your car loan, home loan, student loan. Okay, so the minimum payment each month is the same. That's installment. All right, last category is age of accounts. So if you take all of your credit accounts, back up to credit mix, I apologize. To get a good credit mix means you have a good credit mix would be a couple of revolving type, which is, say you have 1 or 2 credit cards. So that would be, maybe I have an American Express card and a Visa card. So you have 2 credit card accounts that are revolving, and then a car loan and a home loan. It's exactly what we have. Okay. If you have student loans, that happens. So that would be an installment. A good credit mix is a couple of each. Okay. If you only have revolving, let's say you only have credit cards, that's great for you. Congrats. But it actually doesn't show that you're handling both types of accounts. So eventually it'll actually lower your account if you don't have any installment and all you have is revolving. It's kind of interesting. So the credit calculating companies actually like to see that you're handling each type responsibly. So that's what credit mix is looking for. It's not as big of course, credit history is way more important to keep track of than credit mix. Let's say, you don't have any installment portion of your credit card or credit mix. It's not like you should just go out and buy a car loan to get that balanced. If you've paid everything off, good for you. You're in a good shape financially. Your credit score just might drop a couple points, but you're better off being safe financially and not just picking up loans to do that. All right, age of accounts. So this basically is take how many months your credit-bearing accounts have been open, right? Add all those together and divide how many there are. That's your average age of accounts. So it's a monthly kind of a number that's a monthly. So let's say I have a car loan that I've had for 3 years. That car loan has an age of account of 36 months. Okay. And then let's say I've got a credit card that's been open for the last 7 years. Okay. That's going to have 84 months to it. So you got the 36 and the 84, you're looking at an average of 60. Now, of course, 60 months. Of course, you probably have other accounts, and those would also factor in. But I just, give you an example of if I had 2 accounts. Now, what happens if you close an old account? Well, let's think about it. If I close that credit card that I've had for 7 years, I've just lost something that was 84 months old. So my average age of accounts is going to drop. Okay, the average was going to be 60. If I drop the 7-year-old credit card, we're going to be down to an average of 60 months. Okay, so we got to be a little careful on that. We've just got to be aware of it. And again, go back up to this thing. Timing is everything. If you're in the middle of buying, trying to look for a mortgage for a house, that's going to hurt your credit by a little bit because you're looking for new credit. Now, if you go and close accounts, because people have done this before, you go and close accounts that are old just because, well, I just want to close those up and solidify my credit a little bit. It actually hurts your credit. So you don't want to close an old account. There's not a lot of benefit to doing that as far as credit score goes. Now, should you close accounts? Sometimes it's good for you to do so, but don't do it at the same time you're looking for a home mortgage. Timing is everything in these credit moves. Okay. What happens when you pay off a loan? Well, if I pay off my car loan that I've had for 3 years, of course, as long as, let's say 36 months is an above average age of accounts for me, right? Paying it off will lower my average age. If 36 months is low for my average age of accounts, paying it off will raise it. So it just really depends on what your average age of accounts are. This is not a huge impact on the score, but it can be just enough if you're looking for, like I said, a home mortgage could be just enough to knock you out of the approval rating. So be careful when you close or pay off loans, close accounts or pay off loans. Make sure you know what the impact to your credit score is going to be. All right, that's all. Just teaching you about the different categories for today. What I will get into in the next installments, we'll get some more specific examples of what credit history might look like, how could it impact. Credit utilization is a big one we'll go over, and hopefully this will help you get started. Oh, and we'll definitely go into how do you start to develop your credit by yourself safely and steadily. Hopefully this is helpful, and thanks so much.